So, as expected, they did not make a change to the federal funds rate. It was 5.5% prior to, and they kept that the same. But there were some interesting data points that came out of the meeting that follows that statement, right? So many of the times when they issue the Fed funds announcement, there'll be a meeting afterwards, and you can kind of tease out from those comments kind of what they're expecting in the future, right? Mm-hmm. What was even more important, this one is every so often they release something called the Summary of Economic Projections. And it's kind of their multi-year look at three core things, right? Economic growth, inflation, and their forecast of where they think the federal funds rate will go.
So what everybody's going to want to know is how this all, what this means for mortgage rates. And I think what we've been seeing over the last, for the time being, is most of the conversation has been around inflation and how it's kind of stuck at 3%. Is there anything that he said yesterday that changes that narrative, or that should help, would give us any indication that anything is going to change anytime soon with mortgage rates?
Yeah, I think this was pretty fact filled, right? But it may not be for the news we want to hear. So in that summary of economic projections and in their comments, they really hinted at a couple of things. Number one, and I don't know if you want to bring up the chart or how do we want to do that. After the Fed announced, right, they issued what I call their summary of economic projections that looks at those three core things, right? Economic growth, their forecasted federal funds rate, and inflation. So what was interesting is the market took the announcement on the chin. I mean, it did really well, right? We did not see a sell-off in the market. And you would almost expect that with the data that got released, right? So the thing that we're looking at today is their expectation, right? So the blue line is what the Federal Reserve expected their Fed funds forecast to look like in December. And the red dotted line is when they met in March. And you can see that when they met in March, they actually increased their expectation of that Fed funds rate in both 2025 and 2026.
So don't they,
right? So what that means,
they control the Fed funds rate, right? So this is them predicting what they're going to do.
So this is their prediction of where they think the federal funds rate will be in the next 2 years, 2.5 years, right? So it's if you see it increase like it is, that's actually not good for interest rate sensitive sectors of the economy like ours, right? That would indicate that their path to lowering rates got extended out. It's not going to happen as quick, even as they expected back in December.
So this is the Fed saying, hey, we don't expect to change the rate that we control until later, the rates that we can, or I guess a better way to say it would be, this is the Fed saying, we don't anticipate the rates that we control being as low next year as we said they would be when we talked in December.
Fewer cuts.
Yeah, so remember so you got to think the Federal Reserve is a group, I think it's 10 of them, right? 12 of them that meet every couple of months, and they're ingesting all this new data every couple of months, and then they revise that forecast, right? So this was one of the moments where they released that forecast to the market. And in this example, right, it's what it's saying is, hey, we estimated inflation to come down at, this pace in December. But now that we got this new information, primarily inflation and the jobs data, they're saying, hey, we still expect it to come down, but we don't expect it to come down at the pace we once thought it was. Yep. That is typically a negative for the market. The market or interest rates would typically rise on that news, but they didn't.
Tad, can you address, I think, and you can address this deeper, there's a lot of conflicting data coming in, right, from the Senate. Even, I think, after the Fed announcement, there was overseas news, right, with some recessionary fears overseas, some surprising cuts overseas that competes, obviously, with the conflicting data that we're getting. So a lot of mixed messages in the market right now. Would that be good?
I would say that may be the case globally, right? But if we look at what the Fed is looking at right now, to me, everything is pointing at a pretty strong economy, right? So if we look at the next chart, just as jobless claims, remember, if you followed these, we really focus on two things, which are Jobless claims, yes, right. So jobless claims is an indication of are people getting laid off at a high rate, right? And this is a 2-year history of what we call weekly jobless claims. So every week the government surveys parts of the economy to understand how many people are filing for unemployment claims initially, right? And so this is going back all the way to 2022. And if you look, although we saw a bump in mid 2023, right? You see the chart kind of go up and to the right starting in 2023. More people were losing their job, right? But right around mid 2023, you see that line come right back down. We're at the same place we were 2.5 years ago, right? So if you go back to what we thought the economy was 2.5 years ago, a really good economy, you're at the same place you were then from economic growth perspective as it relates to jobs. So the job market looks, to me, really strong. So the thing you would look for in a recession are these jobless claims moving up and moving up substantially, and you just don't see that in the data.
Are there some of that, and I haven't parsed it enough yet, from the full-time jobs gained or lost, part-time? How does that play into that?
Well, jobless, I can't get into that detail. I think, I don't know. If you ask me, right, are people losing their jobs more and more? It doesn't look like they are. Are their earnings going down, right? So if you would think about if more people are taking part-time jobs, either they've got to hold multiple jobs to maintain the same earnings rate. So, but the earnings rate isn't dipping either, right? So, I don't know how true that the part-time job hypothesis is playing out, because the data is saying that people are still earning, earnings rates are increasing, and people aren't losing their jobs at a rate that would indicate a recession.
So the good news, bad news here with jobless claims is, the good news is people aren't losing their jobs. The bad news is that the irony is that means that the Fed is kind of waiting for people to start losing their jobs for them to start to adjust rates down. Exactly,
right. So if we go back to October of last year, right, we had a couple of things. If you go back to October, even on this chart, right, jobless claims were a little bit elevated. You could see they were coming down, but a little bit elevated. The inflation picture was much different, right? We really kind of hit a trough and can't get much lower in inflation, at least what the data shows the last 2 months, right? So the economic picture's changed a lot, right? And this is what I would say is, I hear folks comment and use the Fed funds futures, right? This is what the market is forecasting rates to do, the federal funds rate. Mm-hmm. And in December, forecasting 7 rate cuts this year. 7. We're down to 3. Right. That's what the Fed always indicated, even in December, was 3 this year. So the market can get ahead of itself. And so if you use that as an indication to say, hey, this means the Fed will cut, that isn't necessarily the case. You're better off using the data that the Federal Reserve releases and use, right, to set that Fed policy and that Fed funds rate.
Wishing it were so does not make it so, right? He's waiting for those cuts, but they're not coming.
Right. And and here's the thing, right? The Federal Reserve, in that summary of economic projections, still kept rate cuts this year at 3, right? They did. What they did is they increased next year's, decreased the amount of Fed rate cuts next year, right? The other thing, if you want to bring up the GDP chart, right? The other
that would be
forecast they look at.
There you go.
Is the GDP estimate. So GDP is gross domestic product. It's like an aggregate way to say, is the economy growing or not? And very much like the last a couple of prior charts ago, the blue line is kind of what they thought growth would look like in December. And the red dotted line is what they thought growth would look like over the next 3 years in March. And you'll notice they increased 2024's economic growth quite a bit, substantially, right? And so what does that mean, right? If growth is happening, it's, inflation isn't necessarily in a position to be subdued when growth is happening, right? It necessarily can't, it's just a little bit harder. So you tie these things together, right? The jobless claims are evidencing a fairly strong job market. That feeds GDP estimates, right? Revising growth estimates up, and consequently revising inflation up a little bit, right? So that's kind of the summary that they put out this week. And the market reacted. When you think about it and you absorb all of that information, you would think, hey, that should be net, what I would call bearish to the market, right? Rates should probably rise, even if incrementally, right? That's negative, net negative. But they've kind of held in. They actually rallied on the news, right? And went a little bit lower yesterday. Because when you think about it, all the things we're talking about right now is the Fed funds rate, right? And that's their monetary tool they use to influence economic growth and inflation. The other tool they have is quantitative tightening, right? We almost forgot about this. Remember back in the great financial crisis, right? We entered into a new monetary tool called quantitative easing, right? Which flooded the bank with reserves to enhance and push lending. And about a year and a half ago, we needed to kind of turn away from that, right? And start to go to a little bit more restrictive monetary policy. So the Fed actually has two tools, right? One is the Fed funds rate, which has indicated they're keeping that flat, right? And still expect 3 cuts this year. But what they also talked about was slowing the pace of quantitative tightening, right? So if you're slowing the pace of quantitative tightening, you are by definition loosening the financial conditions. So it looks like the market reacted favorably to the extension of, or the slowing of, that quantitative tightening, right? Which will also loosen financial conditions.
So when you say they're slowing the pace of if quantitative easing is them putting money into the system, quantitative tightening is them taking money out. But what they're saying is they're going to slow the pace that they're pulling money out of the system.
Correct.
Doesn't that
so by slowing the pace of pulling money out of the system will necessarily keep financial conditions looser than they would be if they continued at the same pace.
But doesn't that go against, so if inflation is higher than they thought, jobless claims are still doing better than they thought, wouldn't they want to pull more money out so they could stabilize things faster?
Right. So you're running into you'll hear a term called fiscal dominance, right? Our budget is unbelievable right now, and we are printing a lot of treasury bills and bonds to finance that deficit, right? So at some point, the Federal, if they don't stop quantitative tightening or severely reduce it, the Federal Reserve will start to compete with the U.S. Treasury for like liquidity in the debt market. So what's interesting to me is, going into an election year, right, which historically you don't get like big Fed moves, right? The closer you get to the election. So if you think the Fed is going to tighten, they're going to probably need to tighten probably before June, loosen. They're going to cut. The Fed's going to cut this year going into an election year. They're going to want to do that sooner rather than later, right? So they probably have until about June to get that cut in. They don't have it by June, the likelihood of them cutting, going really deep into the election year, I think would be interesting, right? They may take a more hands-off approach then.
So the Fed just basically doesn't want to get involved in politics, right? That's why they would be delaying that, or what is that the motivation?
Correct. The Fed is considered an apolitical institution and don't want to be viewed as one in which is favoring a political party or not, right? So they do their best to stay out of that. So it's a very interesting. Go ahead.
No, so I just want to make sure. So the Fed typically doesn't do anything the several months leading up to an election. Is that fair to say?
Historically, right? If you look at the data, so what I think the benefits, like if I can say, what can I take out of this that's positive? I would classify this as what we call a dovish statement. And what we mean by that is a dovish statement is a statement issued by the Federal Reserve that's very pro low interest rate, right? A bearish statement is one in which they are very they're pro higher interest rates, right? So the net of all of this meeting, the market is taking it as a dovish response. I think in the combination of all things, the net negative of it is they're taking it as a dovish response because it looks as though the Federal Reserve is willing to accept higher levels of inflation, which is a net negative, both for interest rates and just us as living, right? So that's what I think is the most interesting part is this word salad that they use in this approach is potentially getting us and the market comfortable with a higher baseline inflation rate. The Fed has always argued that a 2% inflation rate is acceptable rate of inflation that they try to stoke in order to maintain aggregate demand. What you may see is them start to increase that expected inflation rate to maybe 3%, right? And why would I say that, right? Well, if you look after the announcement, two assets really took off right after the announcement, and that is gold and Bitcoin, right? And those are assets that are really counter to the money printing supply component, right? What we call M2. So when you see quantitative tightening being reduced, when you see this acceptance of a higher rate of inflation, right? That's those two asset classes reacting to that and saying, hey, we see the Fed really being in a pickle where they're going to have to accept higher rates of inflation, right? Kind of given the circumstance.
So the summary of all of this is the Fed has changed. So, okay, to summarize, the Fed has changed their projection of rate of well, first off, what we started off with, the Fed has changed their projection of what the Fed funds rate will do. And that's the rate that they control. So that's essentially, isn't that like a self-fulfilling prophecy? Hey, we see the Fed funds rate now being higher than what we originally said next year, which probably means the Fed fund rate is going to be higher than it will than
you would think, but then you wouldn't see revisions then, right? They got this one pretty wrong in December, right?
Okay.
Because they're basing it off economic models that change. And now if they're making different assumptions in the future, correct, they're making different assumptions of what their reaction will have to be to those economic numbers.
Yeah. Okay.
Right. You look at January, February inflation data, and that came in hot. There's no two ways about it. All three of them, right? The PCE index, the CPI index, and what we call the PPI index, right? Every one of them came in higher than expected for both January and February, right? So this is why in our market updates, we always watch inflation and jobs, because they're going to tell you what the Fed's going to do, right? So March is going to be critical. Like, a third data point that indicates flat or increasing inflation, right? How do you cut rates in that environment?
Hey, Tad, isn't another big headwind to lower rates? You can speak to it. Is as you talked about quantitative easing and tightening, is just the amount of debt that is coming to the market that has to be absorbed?
Correct, right? So the term you'll start to hear, or you've already heard, is what we call fiscal dominance, right? And that happens when almost a crowding out happens, right? Where the government is in need to print so much new bonds and bills, right? It's going to crowd out other things, right? And so the deficit, what did we increase the deficit 2 trillion last year? We're at 34, 35 trillion. Those are unfathomable numbers. That I think the bigger concern there, from that perspective is we're at a 3% whatever unemployment rate, right? We're in almost full employment, right? Our economy is not in a recessionary time, and we're running budget deficits over 7%.
Right.
Historically, that only happens in recessions to run that high of a budget deficit. So if you're running a 7% budget deficit in good times, if you have a hiccup, that's going to get really out of hand, right? And I think that's what gold and Bitcoin are looking at, is like, hey, this is, given the deficit that you're running, given the fiscal spending that you're requiring, even I think, in the budget proposal from Biden, right, is another increase, year-over-year increase, right? So what will be interesting is the market looks to strike against that fiscal dominance by, saying, hey, we're not going to be big buyers of the US dollar. We're going to look at alternative assets like gold and Bitcoin as stores of wealth and stores of value. And finding a way to push back against that kind of uncontrollable spend.
And 10-year treasuries and mortgage bonds are victims of that then, right?
Yeah, so everything's a victim of the Fed funds rate, right? So what's also interesting in that statement, I think they've realized that they want to wind down the percent of mortgage debt on their balance sheet. I think that started with Bernanke and the QE time. I think what they're realizing, given potentially the impacts it had to house prices over the last 10 to 15 years, that may not have been the most effective way, right, to provide loose monetary policy, right? So you may see that composition switch more to treasuries in the future.
Didn't they start doing that and then COVID hit and they had to readjust?
They blew it out, dude. Part of that was to fix the market, right?
They flooded it,
right? It broke. I'd never seen anything. Never seen a market act like that. That where I saw the MBS market break.
Yeah. Okay. All right. So all in all, how would you describe what does this mean for loan officers?
Yeah. So I think, those hoping for 5% rates, you're going to be hoping for a while, probably, right? What to me, it almost solidifies you're going to be in this range bound 6 to 7% range, right? And those hoping for some relief, I mean, none of the data is saying that, right? The only relief you could get would be that of a negative kind, where you have some shock to the system.
What would have to happen for rates to go to 8 or 9%?
Inflation.
Yeah.
Inflation, or right, I don't think how likely this is, but if the
fair, we'll cover. I'll give you some time to think through that, so I don't catch you off guard. We'll cover that one in a long time.
Yeah, Travis, I think the positive aspect of that, on the flip side, the housing market, was the supply and demand of housing. I think it's going to be very stable, and I don't think you'll see a lot of downward pressure. I don't know if Tad would agree with that.
Yeah, I think you're going to want to so if you've got a Fed telling you expect higher rates of inflation, how are you going to beat that? With assets. Right. So the desire to own assets, physical and digital, are going to be in high demand if that comes true, or continues to prove true, that we're going to kind of bear a higher rate of inflation over a longer period of time. The biggest losers in that are going to be low to moderate income people.
How so?
They're typically low to moderate income wages don't outpace the rate of inflation, so they become poorer every year.
Yeah.
Yep. And they don't have the assets that housing.
They don't have the to invest, right?
Yep.
So the way you combat higher rates of inflation are finding assets that can compound at a greater rate than the inflation rate.
Got it. Okay. Anything else you think that Powell covered yesterday that should be relevant for the mortgage market?
Nope. It's eyes on inflation and jobs at this point. Back to that.
Okay. Don, any you think
no
is relevant from this?
And they all know, everybody knows exactly what they know until they don't. That's basically economic theory.
Yeah. Okay. All right. Well, thanks, guys. We'll get back to it. I think what a good routine would be, we'll do our weekly updates, and then after the Fed has something interesting to say, we'll do these deep dives on a monthly basis.